Hello everyone, this is Lee DeLorenzo from United Asset Strategies. We'll be joined today by Thomas Healy, our Chief Portfolio Strategist, and Matt DeLorenzo, our Chief Investment Officer. We're going to talk about what's been going on last quarter, where we are, and where we're going. So as we've been doing, I usually kick off with a little bit on returns for the stock and the bond market. It was another good quarter for most of the stock markets, and this was primarily fueled by ongoing fiscal stimulus, an accommodative Federal Reserve, and an economic improvement across many metrics. We had the S&P 500 up about 6.2%, and the same reason why the stock market was up, this stimulus and this rocket fuel that we've got going on, was actually a headwind against the bond market. Yields started to drift up, and there were inflationary fears. So one of the bond indexes that we often use is the Bloomberg Barclays Index, and that was down 3.4%. And last year we spent a lot of time talking about the divergence between value stocks and growth stocks. You would think that during the period of unemployment and the virus that there would be a flock to value. That didn't happen. But during the last 2 months of the year, as we pointed out earlier, the value stocks started to do better. And for the first quarter of 2021, they came roaring back. Value, as measured by the Russell 1000 Value Index, was up over 11%, and the Russell 1000 Growth was up 0.9%. And the value was so strong that it caught up to the S&P 500 on a year-over-year basis. The comps, March to March, are very staggering. Both returned more than 56%, with growth outperforming a little bit more than that. And when we look inside and we look at what the sectors are doing, which is where United Asset Strategies portfolio managers often excel in our tactical allocations of increasing and decreasing exposure to different parts of the market, those parts that comprise economically sensitive sectors like energy, finance, and industrials were up a whopping 30%, 16%, and 11% respectively. Technology, the darling of last year, was up 2%. As I pointed out, the models at United Asset Strategies, some are passive, but most are active. And those that particularly were invested in value, our flagship Growth and Income, our Growth Plus, our Momentum, took advantage of selling from the higher valued areas and reinvesting into economically sensitive areas. So I'm going to trick Tom Healy right now, and I ask him to talk about valuations and multiples. When the stock market goes up and it's contributed to earnings, what part of the stock market contributed to the multiples? Are they overvalued? Are we equal value? What's the composition?
Okay, that's a great question, because when you look at the overall market from a valuation perspective, on most any metric you look at, it's clearly either at or overvalued. But when you look at certain pockets within that, certain types of stocks continue to show some relative value. And areas like energy, financials, again, our tactical approach, as Lee mentioned, allows us to focus on those areas where we see some relative value opportunities.
Okay, so as it relates to some of the rocket fuel that I talked about in fiscal stimulus, what are the programs that have been enacted, and how do they, what is the size and scope of them?
Sure, that's a great question. It started about a year ago with the CARES Act, which is about a $2.2 trillion rescue package. At the time, it's considered the largest relief package in U.S. history, representing about 10% of GDP being replaced. That consisted mostly of one-time payments, direct payments, and also unemployment insurance benefits, and the creation of a payment protection plan, PPP, for small businesses. That was passed almost about a year ago. That was followed at year-end during the budget process with another $900 billion fiscal package that consisted primarily of another round of stimulus checks and also an extension of the unemployment benefits. And then more recently we had what we call the American Rescue Plan that President Biden signed into law. It's about a $1.9 trillion package. Again, direct payments, unemployment extensions, also had state and local funding, things of that nature, vaccine funding. And that, when you look at the size of that package, plus the $900 billion, is set to replace about 11% of GDP in 2021. And just for some perspective on that, back in 2009 at the heart of the great financial crisis, the fiscal stimulus there replaced about 6.9% of GDP.
So do we have any other fiscal policies that you think will follow through? And if we do, what do you think the chances of passing on?
Sure. Yeah. Right now, President Biden's working through what he calls the American Jobs Act. That's about a $2.3 trillion infrastructure plan. It's a little more complex because there's three packages. The first package is more of your traditional infrastructure, roads and bridges. It also includes things like broadband, things that are clean energy related, climate change. Phase 2 is social infrastructure, they're calling. That's community colleges, child tax credits, in-home benefits for elderly and those with disabilities. And then phase 3, or package 3, is the tax package, which is going to be the pay-for in the whole process, which includes some of the major provisions are an increase of the corporate tax rate from 21 to 28%. The highest tax bracket goes back up to 39.6 for individuals. And then there's some other estate planning oriented things like the stepped up cost basis at time of death, things of that nature. So there's really three parts to this package that's really started the negotiating process with a meeting today between President Biden and Republicans.
So the idea that we've got a split Congress, 50-50, with our Vice President being able to cast a vote, what do you think the chances of a ram through of everything that President Biden's proposed is versus negotiations?
Yeah, I mean, I think the president's starting with the negotiation part, which is what he did for the American Rescue Plan, met with Republicans, but ultimately passed the package almost identical to what he started with. I think here the issue is, because the Democrats have a majority in the House, they have that majority, 51 majority in the Senate and the White House, it's very difficult for the Republicans to have any real say on the outcome. What's really going to be critical is a handful of moderate Democrats, and where do they come out? Like a Joe Manchin in West Virginia or Kirsten Sinema in Arizona. The fact that they only have the 51 means every Democrat has to be on board. So we're seeing that a couple of things that are going on. One is they're going to look to pass this through budget reconciliation, which just requires a 51 majority, not 60, so you don't need Republican buy-in. And the Senate parliamentarian has made a couple of recent judgments that will look like a lot of this can get done through that budget reconciliation process. So it looks like there's a good chance it gets through. The unknown is how much of it gets done as is and how much of it gets changed by the moderate Democrats along the way.
So one of the things that we do at United Asset Strategies when we see that the ball is moving or the puck is going down the ice is to look at those corporations that might not be hurt as much as others if corporate taxes should go up. So when we're making our sector rotations, not only are we trying to look at areas where the economy is doing better, but also which specific names might not be hurt as bad should corporate taxes revert back to 28%, or maybe something in the middle like 25%. So we just spent some time talking about fiscal stimulus and the tax package that's probably going to be proposed and passed something by the end of the year. I'm going to turn now to Matt to talk about monetary policy. Unlike the stock market that was up, we mentioned that the bond market was down. Yields started to drift up. Does that mean that the Federal Reserve changed their policies in the first quarter? What was going on?
Actually, it's the opposite. The Fed was very accommodative, and they kept to their tune that they want to keep short-term interest rates pinned all the way down, and they continued to put $120 billion a month into their Treasury and agency mortgage-backed markets. So they're really continuing the easy policy, and they've been very consistent in their message that they're going to keep this going until the labor market heals and inflation really comes back.
So the idea of the two I's, interest rates and inflation, the inflation calculation itself, tell us what makes up that CPI. What is the inflation rate all about?
In CPI, a big part of CPI is housing. So you're looking at rents and owner's equivalent rents. That's a big part of it. But when you're comparing our numbers now to last year, and seeing what really moved the most, it's energy prices. So we had a big decline in gasoline and things like that last year. And now that we're a full year past it, we're seeing some pretty big numbers, and those are showing up in the inflation prints we're seeing now.
So the interest rates, if we look at the US 10-year as a benchmark, moved up significantly from January 1st to March 31st. Is that still powering up, or has it pulled back a little bit?
It's actually kind of paused really over the last few weeks. We had something like an 80 basis point rise in the 10-year Treasury yield. And like you brought up, a good part of that was the rising inflation expectations and the market really waking up to the story that inflation has perked up a little bit and the Fed really does want to support the inflation outlook. And then the other part of that was a small rise in real yields. So Treasury real yields are really made up of the inflation outlook and the real yield component. And so far this year, we've had inflation expectations rise significantly and real yields rise a little bit. And that really is what caused those longer Treasury bonds to drift higher and the prices to come down.
So looking forward with your own crystal ball and anchoring it to what you think the Federal Reserve will do because they might have said so, what do you see for the foreseeable future of 2021?
Yeah, so I think that as we get into the second half of the year, the Fed really is very likely to pull back their quantitative easing program. It's pretty extreme right now. It was in place really to support the terrible situation we had last year, and the Fed has wanted to show that they're not going to choke off the recovery too soon. But I think the reality is, as inflation moves higher, which it already is starting to do, and as the labor market heals, when the economy is getting back towards being fully reopened, the next step is for them to pull back on the quantitative easing. So I really think that they'll be careful not to do it too aggressively or too soon, but I think that is what's coming. So some of what's happened so far in Treasury yields, I believe, is the market looking forward to that. And honestly, I think it potentially has gotten a little bit ahead of itself. So I think we can have a pause in Treasury yields for now, but as we move further out, I would anticipate that yields have a good chance of going higher over the longer term.
All right, so both the Federal Reserve as well as United Asset Strategies are going to try to negotiate a soft landing inside of any kind of portfolio adjustments that need to be made. I would like to close it up by saying that the Biden tax proposal it's well written out, so we can understand where different taxpayers individually as well as corporations would have modifications that you might be able to make inside of your planning. It's a little bit early, as Tom pointed out, they're just starting the negotiations, but we are prepared here. We've got estate planning techniques, techniques inside of the 401ks, Roth conversions that we are able to look at for our clients and model them accordingly. At United Asset Strategies, this planning is very important because if we're able to do a plan for someone, we can figure out with more confidence exactly how to invest that portfolio to meet their long-term and short-term needs. And as such, we're pleased to announce that we've added another financial planning associate to the firm. His name is Shane Miller. He's known to us for over 10 years at his association with TD Ameritrade, but he's got 20 years in financial services, and we're looking forward to introducing him to many of our clients going forward. We thank you very much for listening, and we'll see you next quarter.